Hi there, and welcome to the KP Kerner Perspective Offshore Portfolio Report for the half year ending June 2023. We're going to dive straight into the portfolio. We would urge you to watch the KP Big Picture and KP Investment or Asset Market reports for a backdrop to this. We're really just going to run through some of the key holdings. And generally ordered in terms of the size in which they appear in client portfolios. All right, starting out with HSBC, there's a 10-year chart. You can see the shares done basically nothing over 10 years. Very aggressive sell-off courtesy of COVID, and it's really spent quite a bit of time fighting its way back since then. Okay, and what we're going to try and do is really just give a couple of slides on each story to help you get a deeper understanding of the business. But of course, if there are any questions, we are welcome to give us a shout and we'll talk to the color of all of them. All right, so the heading there is a giant in anyone's book. You're looking at total assets fourth quarter 2022 of approaching $3 trillion, reported profit before tax at almost $22 billion. That for us Rand people translates into almost 400 billion Rand. So this is a proper business. Yeah, the reason we like it, very, very well balanced. You can see there, and it's important to say, the three banks in our portfolios all operate geographically across the globe and with very comprehensive offerings. But the HSBC, as you can see there, wealth and private banking or personal banking, then you've effectively got the markets business as well as the corporate bank. There you can see where the profits are generated, and one of the things we like most about HSBC is it's got a very strong emerging market footprint. As you can see, Hong Kong is quite big, and obviously the pain that's been taken in Hong Kong courtesy of the lockdowns, as well as some of the political tension, has hurt them a little there. Asia generally, 4.2 billion. You can see the UK at 5. Out of the developed sector is the only real player. Europe insignificant, US also, which was a fairly unfortunate late entry into the US housing market, which they've largely extricated themselves from. But as you can see, between Hong Kong, Asia, Middle East, and Africa, very strong footprint in emerging economies and high growth nodes. And I think, like all the big banks, probably coming at the expense of some of the smaller and mid-sized banks. We're saying it's big, but it's still growing. As you can see there, sorry, some of these slides might be a little bit small on screens. But you can see they're growing deposits from 2019, which is kind of the pre-COVID world, to now, got CAGR or compound annual growth of 4%. And similarly in assets up some 5% over the period. There you can see revenue also grown nicely over the 3 years, CAGR in revenue and in trade all around the 5%. So, in spite of the fact that they are a really big business with lots of moving parts in multiple geographies, I think in some 70 countries, if memory serves, still growing their footprint. So one of the things we've liked about them, apart from the fact that they give you a great emerging market footprint, is in spite of being really big and complex, they've been working within the portfolio. And there you can see a couple of the sales, as we mentioned, they've been extricating themselves from the US, for example, also planned sales in France and Canada, as well as a few other markets like Russia and Greece, and then increasingly allocating capital towards Asia, particularly China. And you can see there, one of the things we really like about this business, it's got a capital adequacy ratio, Tier 1, of 14.7%. The earnings momentum, obviously all banks hurt 2019, 2020 by COVID. You can see the dotted blue line, and that's really a theme throughout these charts, is the dotted blue line to try and show the earnings trend. Obviously 2023 is forecast to be a very, very good one after a difficult environment. And I think there's quite a few reasons for that. Obviously, rates moving a bit better, but also they've been in a process of shedding some of the non-core assets and getting back to their knitting. And we believe that that, together with some refocused management, is having the desired effect. But the bottom line is both the earnings and the dividend trend, barring the COVID period, looking quite solid. But one of the things that's most appealing to us, and the reason it is still a big holding in portfolios, forward PE multiple, with that cranked up, obviously, earnings number in 23 forecast, still the PE is down at about 8 times, and forward dividend yield very attractive, very much like the South African banks, circa 5.5%. All right, the next one is BNP Paribas, and there you can see we took advantage of some of the weakness around the COVID periods and just before that. In large part, BNP Paribas was very different from HSBC, and as we discussed later with JP Morgan, BNP Paribas very much a European-focused bank, and the big attraction there was the discount to book value. Just very quickly at a glance, it's got a history of over 200 years. It's Europe's leading lender. It too has got a massive balance sheet. It operates with almost 200,000 employees across 64 geographies. Very much like an HSBC or a JP Morgan, all in the sort of corporate and institutional banking, commercial, private, but they're very focused also in investment and protection, investment protection services. And then each of those silos has different, geographic makeup, but generally operating in the Eurozone, in the Middle East and Africa, the Americas, and then in Asia Pacific. But very much a European bank, and their asset base very similar to that of HSBC and Bank of America, who, apart from the Chinese big banks, are in terms of listed, let's call them non-Chinese banks, really are the giants. And as you can see there, around 2.6 trillion euros, worth of assets. And there you can see, over $1 trillion worth, trillion euros worth of customer deposits, and also tier 1 equity ratio of almost 14%. So very, very well capitalized as well. For us, a big attraction here is the fact that it trades at quite a substantial discount to its tangible NAV. The tangible NAV is the blue line. The dotted one is basically the tangible NAV trend line, and the red, the blue bar and the blue trend line are the tangible net asset value per share, and the red line is the share price. And as you can see, it's currently trading around 60 euros, or just a little bit below that, and it's got a tangible NAV of, to end of December last year, of over 90 euros. So very, very big margin of safety, we believe. Right, then on to Shell, previously known as Royal Dutch Shell. We used the COVID-induced weakness where oil prices and gas prices got hit quite hard. We used that as an opportunity to add positions sort of around the £10 mark. Worked really well. It's a very busy slide, and all we're really trying to give you here is a sense of the size of this business. You can see there for the year ending 2022, revenue $381 billion, and it's a giant in anybody's book. It had income for the period of some $42 billion. Obviously, 2022 was a beautiful time for the oil companies and the gas companies. One of the things we like about Shell is the fact that it's definitely pivoting away from crude, although a lot of environmentalists remain angry with the fact that they continue to add capacity there. But you can see, if you look at that block on the top right, you've got natural gas production at 1.3 billion barrels equivalent, and that's basically the same as crude oil and natural gas combined. So very much tilting towards gas, And you can see there, obviously, gas, courtesy of the Ukrainian situation, as we discussed in the big picture, and the asset markets, definitely benefiting Shell significantly, with more than a doubling in the earnings in the 2022 year. And then the segmental earnings, you can see renewables still cost them over $1 billion, and they really are trying to invest in electrification and in renewable technology, basically trying to use the cash flows from fossil fuels to build a new economy, a greener economy portfolio. Generally solid results. 2020, during COVID, when oil prices got smashed way down, you can see the trend line looks pretty decent. The forecast for 23, obviously well off those 2022 highs, but you're still looking at a forward PE to 2023 of 5.5 times and a forward dividend yield of 6%. And again, if you cast your mind back, if you did watch the SA local portfolio commentary, maybe Sasol, similar sort of multiples, but we would argue a much better run business and far more robust, if we could call it that. So definitely a trend of results. And as you can see, reported earnings tend to be a little bit volatile, but the dividends per share fairly consistent. All right, then Micron Technology. It's a company we've held for a few years. We bought it in the $40 mark. It rallied really hard to around $100. Came all the way back, during the tech sell-off to well under 50. It has regained some of its mojo, but still sitting around the $70 mark. So just very quickly, Micron in a nutshell, it's a manufacturer of high-end DRAM, which is obviously PC server memory, and NAND, which is effectively more mobile, sorry, not more mobile, it's more sort of solid state drives and the likes. Their products are used in everything: laptop servers, mobile devices. Generally, they put a lot of money into R&D, and they sit with typically premium product. And they've been caught in the trade wars. So obviously, when China's Huawei was banned in America, it was quite a big knock for them. And then also more recently, China has placed a ban on Micron products, which caused the share price to fall. 2023 is tough, both in terms of pricing and volumes, but we see this as kind of a utility beneficiary of the Industrial Revolution. You just think about driverless cars and stuff like that. Massive need for fast, efficient memory and storage. So we believe this is a good business, albeit in a very difficult space currently. As you can see, the current 2023 earnings have been hit really hard, courtesy of all those disruptions. Before that, the trend was very, very firmly in place, upward. We still believe they produce very useful products, and eventually these trade wars will resolve themselves, and they will, we believe, get back on track, also as conditions normalize in demand. As we said, Micron was caught in the trade war between China and the US, and the US and China, such that this current year is going to be pretty awful. But the market generally looking through that, as you saw earlier in the share price back at the $70 mark. All right, then Volkswagen. It's a company we've held for some time. Obviously, when Dieselgate broke, it hit the share very, very hard. We have been very all right. Volkswagen, as you can see in the slide down at the bottom there, the vehicle sales were hit hard by COVID in 2020, 2021. That's very much like the global trend, with 70.8 million vehicles sold in 2023 as a forecast. That means that Volkswagen, the stable, represents about 12% of total unit sales globally. All right, so Volkswagen offering good value. As you can see there, the earnings trend has been very positive. They've had a couple of anomaly years there, more around the Dieselgate fiasco. this current 23 year is probably going to show earnings a little bit ahead of trend, but you can see the dividend also following nicely. And importantly, there you've got the historic PE at an incredible just under 5 times and a dividend yield of around 6.2%. And those on historics, the forwards look even better. So yeah, we see a lot of value in this business and we think it's really mispriced. All right, then very quickly, we've held the iShares Ultra Short Duration Bond Fund, which is a corporate bond fund for a while, really just trying to give clients some exposure to yield in this ridiculously low yield world we've lived in. I'm not going to go into too much detail, but there you can see on the right-hand side, top right, the top holdings. So you've got some debt, you've got IBM, you've got Morgan Stanley, you've got Goldman Sachs, Wells Fargo, etc. So the top 10 represent 8% of positions. You can see the returns after that ridiculously low 2021 period. Yields have normalized. You can see the very, very short duration. I think that's what we were trying to achieve, to get a little bit of yield pickup, but avoiding government A and also avoiding longer duration. You can see the weighted average maturity there is 0.6 of a year. The average coupon now is 3.37, and you can see some 62% of the assets are in the US. All right, JP Morgan is, you know, the COVID sell-off in the $90 range offered great value. We took advantage of that. JP Morgan is just another one of those giants. In fact, outside of the Chinese banks by assets, it is the largest bank globally with assets of 3.6 trillion. Obviously, you know, when you've got asset management businesses, it tends to obscure those numbers slightly, but still, it's a big bank in anybody's book. And it's also the biggest bank in the world by market cap with a $450 billion market cap. Just a couple of highlights on the F22 results. Revenue was a staggering $128 billion and net profit was $37 billion. One of the things we've liked about them is they tend to be opportunistic in chaos. So for example, they took out First Republic during the global financial crisis, also used the chaotic environment to pick up some good businesses, basically on the ultra cheap. JP Morgan is obviously very exposed to global markets, but it's more of a US-oriented bank, and we believe it's incredibly run. So if I could just pause for a second and say HSBC is very much our emerging market high growth bank. BNP Paribas effectively more of a European footprint with the, let's call it slightly more predictable but less exciting growth that comes out of that. And JP Morgan, obviously, the more exciting of the three, given what's happened in the US over the last while. So JP Morgan has an incredible history of results delivery, as you can see there, you know, going back to 2013. 2022 saw a little bit of a contraction, but not much, but a really nice steep slope, and the dividends following suit. They're well on track with 2 quarters under the belt to give us the $16 per share earnings that the market's expecting. That would put it on a 9.4 PE, and the forward dividend yield 2.7%. So a bit lower than some of the global banks, but still a pretty decent yield compared with what you're getting, say, on cash. Then Diageo is a business we really like. You know, COVID offered a little window of opportunity, but it showed us a clean set of heels. It seems to be in a correction trend, but really we believe the reason for that is simply because even great businesses have a price. As you can see there, in terms of the organic sales with the last results, which was to June, you know, whiskies are obviously a big part of it. And as you can see, the super premium market, which is in that right-hand block, effectively the, you know, those ultra premium single malt whiskies and premium tequilas and things like that. Super premium market growing very, very strongly. Premium also doing quite nicely. Yeah, but you can see it really is not a big player in the beer market, and that's something we quite like. We like the distillers and the ability they have to actually run margins and drive margins through effective positioning, which is something we don't think the brewers, like the Heinekens and the AB InBevs, have the ability to do. All right, so Diageo's delivered strong earnings per share growth, not spectacular. It's not sort of what we've seen out of a JP Morgan, but very, very solid. Obviously, 2020 and 2021 were hit by COVID. The historic PE of 19 times is a little bit demanding, obviously, as the world recalibrates to higher interest rates. Dividend yield is decent at 2.4, but not spectacular. And we think that combination is really why the share price is languishing, but it's a great business with an incredible portfolio. All right, GSK, GlaxoSmithKline has been disappointing, we have to say. More recently, they unbundled Haleon, which is the consumer business, which we'll have a very quick look at just now. So GSK is now a very focused pharma play, biopharma play. It's got a very strong vaccines portfolio, which is one of the things that drew us to it originally, because we prefer higher visibility, more defensive pharma rather than sort of the blockbuster type of pharma. And we believe this company does that for you. But increasingly, their future is going to be focused in more cutting edge immune system, human genetics, and advanced technologies. One of the things we also like is, they really are getting their head into 21st century medicine with sort of customized medication based on DNA, etc. So a very interesting business, and also become the target of activist shareholders, courtesy of the share price not doing awfully much. All right, so the earnings growth has been solid but dull, we have to say, and I think one of the reasons is it had Haleon in there, which we really like the portfolio, we like the cash flows, but I think the market didn't like the fact that it was a combination of consumer product and pharma, and now that it's separated, we think the pressure's on Emma Walmsley and company to take this business forward. They are looking for, let's say, over the next 4 financial years, revenue growth of 5% or above in constant currency, and earnings growth of 10% and above in constant currency. And I think management really have to deliver on that, or those activist shareholders will definitely move. So although it's been a little bit uninspiring, forward multiple of under 8 and dividend yield of 4.2 makes it look quite compelling, we think. Then Microsoft is something that we added quite recently to portfolios. The tech sell-off late in 22 and early 23 created a window of opportunity there. And really what we're saying is Microsoft is almost more of a utility than it is a pure tech play. You can see productivity and business processes, which are, for example, your Office suite, then intelligent cloud, and then personal computing, which was more around the Windows operating system. You can see how nicely productivity and intelligent cloud managed to grow its revenues in the last reporting period. That was, financial year 2022. Those up 15 and 10% respectively, whereas the lack of shipments of machines resulted in a decline in sort of Windows-oriented sales. As you can see there, the Q4 2023 results, again, solid growth, constant currency growth of 12% in productivity. And if we could just pause there, anybody who's got Office 365 now, which is you kind of have to have, every year, every month you get debited for your use of the Microsoft suite, and we're becoming increasingly reliant on it. That's what we like. And then the intelligent cloud is sort of Azure and the likes. You're seeing a lot of massive corporates in the States and elsewhere in the world relocate onto the intelligent cloud and developing very interesting technologies within the Microsoft product suite. And then, more personal computing continues to languish, and we would hope that new device shipments will start picking up. But as you can see there, GP margin 70% and operating income margin of 43% is really very, very compelling. And yeah, the bottom line is there's tech in there, but it's a beneficiary of the fourth industrial revolution without being cutting edge tech. So, our view on this thing is more tech, less tech, more utility is more earnings mojo. You've got to be honest, the forward multiple to 24 of 30 times is very, very rich by any metric we use. But that growth that we've seen in the last while, probably helped by some currency movements in the next period, will help us to unwind that multiple. But the dividend yield of a little under 1% might seem uninspiring, but they do buy back quite aggressively, and that obviously returns to shareholders in a different way. All right, then BMW has actually been a very good performer. It was disappointing for some time. One of the things that drew us to it originally was obviously the family, the premium offering and the aspirational brand value that it's got in a lot of emerging economies. But we also like the fact that they've got a very good EV portfolio. All that has been sort of disappointing. There you can see the earnings per share, again, 2019, 2020, disappointing. 21 and 22, the earnings momentum restored, and you can see the dividends also improving very nicely, although the forecasts are definitely for lower earnings after sort of the anomaly of last year. Then on the China ETF that we bought for a few clients, the rationale there is that China obviously has been a sleeping giant for the last 5 years or even the last 10 years. Just a very quick few data points on the tracker. It really just is a China, Shanghai, Shenzhen tracker portfolio. You can see there the biggest holding with about 6% is Guichao Mutai, which is a brewer, which is a giant in its own right, followed by CATL, which is obviously more a new era kind of business, being more in battery tech and the likes, and quite a lot in banking, but even a business like BYD featuring there. You can see financials representing about 18%. We would probably have liked something a little lighter than that, but we'll take it. And then, of course, information technology is the likes of Tencent and Alibaba and so forth. And then what we quite like is consumer staples at about 14%. So, one day, sooner or later, China will kick into gear and this tracker will do well. All right, process. We bought in client offshore portfolios when we had cash, simply because we saw a window of opportunity when it got hammered on that sell-off, courtesy of the Chinese clampdown on the tech companies. But the story is well known to everybody. It's really a Tencent proxy. Then Richemont, we also used the weakness around some anxieties about slowdowns. At the time we bought it, cash probably represented about 12 or 13% of the share price. It just felt quite compelling. Of course, that's done very well, but not quite as well as it's done in Rand terms, because obviously the Rand itself has been weak. Then an interesting play, Brookfield's Renewable. It's effectively a private equity fund with a listed entity. It's Canadian based. So that chart doesn't look spectacular, and we are slightly down on our position. But the story here is that it's critical for the world to move electricity production away from fossil fuels. As you can see, transport represents about 28% of global greenhouse emissions as a sector. Electric power, as you can see there, is the next biggest at a 25%. So estimates are that the global economy is going to have to invest around $3 trillion a year for the foreseeable future in order to rebuild the electricity network. Those are big numbers. That not only requires a lot of funding, but it also requires a lot of skill, and that's one of the things we like about Brookfield. You can see there it's still fairly small. They've got generating capacity of probably about 26,000 megawatts. which is probably around half of what Eskom can generate, but they've got a development pipeline of 110,000 megawatts. And importantly, they don't just do work on their own balance sheet, they can also sort of manage for corporates and governments where those countries and companies have made commitments in terms of their emissions. You can see it's still currently quite US focused or North America focused, with about 60% of the capacity sitting in the US, and the bulk of that sitting, which is about half, sitting in hydroelectric. But we believe that this business is uniquely placed to benefit from the incredible investment that's necessary in green electricity. And we also believe there's going to be a fantastic opportunity with the scarcity of green capacity for businesses like these and entities like these to generate superior returns off higher prices. And then finally, we've got Halion. Halion was unbundled out of. Yeah, and then Halion has got a great brand portfolio. You can see they operate in oral health, vitamins and supplements, pain, respiratory health, and digestive, with portfolio brands like Sensodyne, Centrum, Advil, and Voltaren, Otrivin, as well as Eno and Tums. So a very, very good, very strong, very cash generative consumer portfolio. The multiple to December 23 looking a little bit full at 17 times. Dividend yield also not exactly spectacular at 1.7%, but we believe this is a very solid business, and we believe that separate Halion and GSK will do better than they would have together, both operationally and in share price performance or value creation. So that brings us to the end of this. There are obviously one or two portfolios with a couple of peripheral holdings that we haven't covered here, but those are generally quite inconsequential, and we wanted to try and keep this to around half an hour. If you've got any questions or comments, please reach out to us, but we thank you for your time and attention, and we hope you'll enjoy the final one in the series, which will be the local Flex Fund report.